The time to be reckless is when you're scared to death.
Hmm.
All of the headlines tell you that the world is coming to an end. And all you want to do is hide in fetal position under the bed, clutching your few remaining savings. That's the time when you invest.
I want to make I want to, unlike the Fed in May, I want to pivot here and talk about gold, because that's also sort of a, I mean, maybe that's not even a pivot from what we've been talking about so far. But it seems like gold is everywhere in the mainstream media, which is not a great
Scary.
contrarian indicator, but even central banks are buying it. We actually, as of last week, even banks like what was it, Bolivia, announced that they'll start purchasing gold directly from miners and stuff like that. So what's going on there? What can you tell me about the precious metals and gold in particular?
Well, let's work backwards. Bolivia buying gold directly from miners is a tax. They're going to buy gold from miners in Bolivian currency, and they're going to buy it at a discount to world markets.
Hmm.
So view that for what it is, which is a different form of theft.
Hmm.
The fact that central banks are buying more gold stands to reason for a couple of reasons. The economic outlook in the world is less benign than it used to be. During a 40-year period where inflation was falling, where the benefits of globalization were enhancing the material living standards of human beings, and where interest rates were declining, was a world where you didn't need to own gold. You could own bonds. That all changed beginning in 2022. Globalization, in many senses, gave way to nationalism, fractionalism. The period of lower interest rates was over, and inflation returned. So 40 years of benign economic climate, which favored bonds, including long bonds, is over. The long bond is a very, very flawed instrument. Rising interest rates lowers the capitalized valuation of any income stream. So the central banks that had been perfectly content to own, as an example, U.S. 10-year treasuries, find themselves owning an instrument that reduces their purchasing power by 3 or 4% compounded a year for 10 years. And when they looked for alternatives to the U.S. currency, when they looked at Chinese denominated bonds, they saw a market that was so opaque that they didn't know if the value proposition was real or not. So there were precious few alternatives. And as the central banks looked at their own precarious circumstance, and they looked around the world at how opaque other central banks were, the very lack of confidence that they had in their own operations, and the terror that they had with confronting their ignorance of other people's operations, made them need to go to gold. Gold, too, is difficult to weaponize. The Chinese or the Russians may or may not trust us, but historically they haven't trusted each other. Would the Russians accept some renminbi, knowing that they were going to buy goods and services from the Chinese? Yes. Would the Chinese accept some rubles, knowing that they were going to buy natural gas or something else from Russia? Yes. But would the rubles constitute a real asset class for the Chinese central bank? Almost certainly not. I mean, Russia is a gas station with an army. Conversely, would the Russians, who 15 years ago had a shooting war with the Chinese across the Amur River, really consign their financial future to an asset class that isn't convertible and is opaque? Of course not. Gold fills that role. Gold does well during periods of time when people are concerned about the maintenance of purchasing power in conventionally denominated assets. And that time is today.
Hmm. So I get that, I get the long-term view on that, but I'm also thinking sort of over the short term, and I'm thinking about buying opportunities and when they might or might not occur. And given that gold is currently at historically high prices in nominal terms, would you expect it to, if there was market turmoil and a liquidity event, would you expect gold to give some of that price back and provide a better buying opportunity?
If there is a real liquidity event like 2008, almost certainly. Remember that in a liquidity event, the investor doesn't make the sell decision, the margin clerk does. And the margin clerk will sell anything that has a bid, and gold always has a bid. I remember in 2008, gold held its bid for 24 hours, and then it collapsed too. People went to cash to service debt, and they didn't make the decision. Their bank made the decision, and their bank didn't give a damn what the investor thought about gold's attributes. They wanted the loan paid back now because they had to pay back their own debts. In a liquidity crisis, all ships sink, and then the best ships refloat. In a liquidity crisis, the techniques that have been used by central banks for 100 years have always been to inflate. The policy response to a liquidity crisis would likely be very, very good for gold, but you have to get from here to there. I need to take some issue with something that you said. You didn't say all of. You said that gold was priced at record terms in nominal terms. You need to remember the phrase nominal. If you compare the gold quote at $2,000 with the gold quote in 1982 or 1981 at $850, you need to understand the damage that's been done to the purchasing power of the dollar in an ensuing period. Against most currencies in the world, gold is at record prices even in nominal terms. In the US dollar, it's only at record prices in nominal terms, not in real terms.
Yeah, that's what I meant when I said nominal, is that it's at $2,000. It was at $2,000 before. Obviously 2000 today is not, is it? So what else I've been thinking about is mostly as a speculator, because you said the best ships reflowed, and I'm wondering what's happening with the gold miners, because while the gold price should be relatively okay for them to make money, not many of them are making money, and the valuations are suffering under that, on top of there not being enough liquidity in the markets. So how does an intelligent speculator, seek exposure into the gold space?
Well, I think he or she has to segregate. I don't think that you can buy the sector, the whole sector. If you bought the top 40 gold mining companies in the world by market capitalization and liquidity, you would be buying in that 40 stock package 25 stocks that I couldn't own with a straight face, because they aren't great businesses. You have to do a little bit of work. You should make money, gold mining. We have seen, although the gold price has risen some in the last 5 years, we've seen costs and expenses rise much more rapidly than the gold price. The energy price is an example. The oil price has gone from $20 to $70. Inputs are important. More importantly, social rents, which is to say the impact of regulation, royalties, taxes, and fees, have been growing at double-digit rates around the world. But there are companies that have good margins, that generate good free cash, that have a demonstrated track record over 10 and 15 and 20 years of reinvesting cash flows at accretive rates, which is to say they generate more value than they spend relative to their cost of capital. And these companies have names. The investors need to do a little work to separate, in old-fashioned movie parlance, the good from the bad, from the ugly. People need to do a little work, or they need to pay people to do that work for them.
Is there a moment in the market that you would prefer to have producers as opposed to developers and explorers as opposed to producers and stuff like that? And where do you think we stand now?
Right now, I think the best value, ironically, is offered up by the biggest and best producers. I don't think that they'll perform in the market the best. I think the ones that will perform in the market the best are, ironically, the single asset producers or the less good producers that have a high cost of capital, where their shareholders, ironically, will benefit by being taken over by better companies. These are capital-intensive businesses. And if you have a lower cost of capital as a consequence of your reputation, and you take over a company that has a higher cost of capital, You can benefit in the very near term, the shareholders of the company that you took over, but that takeover can still be accretive. So I think the best market moves are likely to occur in the intermediate or single asset producers. I think the best value is in the large companies. And probably the correct response from investors would be to buy the best of the large producers for beta. And then if they have the courage to look for less good companies that are likely targets of takeover and consolidation.
I'm kind of afraid from the single asset producers after that whole pure gold fiasco that Eric Sprott had with it. And what went
understand
wrong with it.
that's coming way down the quality trail. When I was talking about those types of companies, I was talking about the Sentimans or the Alamoses of the world. Pure Gold was a developer, and I would be putting Pure Gold in the camp well below producer. I would be putting it in the development category. And we could talk probably, if you wanted to, at some point in time, we could do a post-mortem on Pure Gold. Because I was a shareholder to the lender, I know a reasonable part about that story. And I was and am friends with the people who were responsible for the early success and the later demise of Pure Gold. I'd be happy if you wanted to do a post-mortem on Pure Gold, but I wouldn't confuse it in the spectrum of gold companies I was talking about as anything other than, at best, a junior miner.
Okay, fair point. When it comes down to taking risks, you're on record saying that you like taking jurisdictional risk. You've recently been talking about Guyana, I believe, and Suriname, and countries like that. What's
Suriname is probably the equal of Guyana in terms of geology. Guyana is a unique circumstance where a country with 1 million people has a reasonable, intelligent mining code, has great geology, and has 10 billion barrels of recoverable oil. The pressure on the Guyanese government to do the wrong thing with regards to their gold industry is low, because they're going to enjoy such an incredible inflow of capital from the oil business that the whole country has a chance to develop. Guyana doesn't have to do it right. They just have to do it not too wrong. This is a really unique circumstance. And when you combine that circumstance with the two adjacent discoveries made by G2 and Reunion, which I believe, I don't know, but I believe they're actually one discovery. I think they're two separate parts of one very large ore body. If you combine what I think might become a 10 million ounce deposit, that is to say, a must-own deposit for a major, with the almost unique political and economic circumstance that Guyana has in front of it, I see it as a very interesting opportunity. I see it as a particularly interesting opportunity because a lot of sophisticated investors, people who should know better, can't spell Guyana. They don't seem to want to be invested in a jurisdiction that isn't spelled Nevada. And when I look at the pro forma balance sheet of Guyana relative to the pro forma balance sheet of either Nevada or the U.S., understanding the great facility that governments often have to snatch defeat from the jaws of victory, I think the relative risk to reward of Guyana is good relative to Nevada.
Especially
doesn't mean they can't screw it up.
No, of course, yeah. Especially if you account for the drilling costs and stuff like that in Nevada, which are also, I get it. Isn't because you mentioned Reunion Gold, isn't that the company that has some sort of a legal dispute with Barrick, one of their shareholders, something like that? I'm not too well aware of the story.
Yes.
What do you think is happening there?
I don't know. I don't invest or speculate in litigation. I'm not a lawyer.
Okay, fair point. Fair point. You have also previously told me that there will come a time to go recklessly long on the market, but sort of from this whole conversation that we're having here, it doesn't sound to me like now is the time to be reckless. It sounds like it's time to be picky, right?
The time to be reckless is when you're scared to death.
Hmm.
Uh, all of the headlines tell you that the world is coming to an end. And all you want to do is hide in fetal position under the bed, clutching your few remaining savings. That's the time when you invest. Uh, Post 2008, where the market had fallen by 50%, and all the big thinkers in the world thought it was going to fall another 50%. When some of the best companies in the world were selling at 6 times book with a 6% dividend yield. That's when you invest. I mean,
Hmm.
that's when you invest recklessly. And I'm not saying we will, but it wouldn't surprise me if we had some form of liquidity event in front of us.
Hmm.
I don't know what the black swan is, and I'm not saying it'll occur. And I'm not saying that you hold your cash in the mattress until then. I think you allocate when the opportunities come. But I believe that there will come a time, and I suspect it'll come in the next 5 years. I don't know. When, if you are interviewing me again, I say, this is the time to come to grips with who you are as a human being and go to war. You know, this is the time when everybody else is selling, when we are in the mother of all sales. And what you're supposed to do in a sale is buy what you need.
All right, so this was the second clip from my conversation with Rick Rowe. In the first one, he talked about the banking crisis. He talked about CBDC. He talked about de-dollarization and a bunch of other attention-grabbing topics normally. But he sort of gave a more level-headed opinion on them. I will probably, there goes my light. I'll probably link that conversation somewhere on your screen or something. Or if you want a full unedited version where we also talked about Rick's most contrarian investment of the current moment, go to resourcetalks.com and you find that under the tab early interviews, as well as you're going to find a community of people who might or might not want to talk to you over there. So you can chat with them on there. If you want Rick to rate your portfolio, that would be ruleinvestmentmedia.com. You can put in your portfolio. Rick's going to get back to you and tell you if he likes the stocks you own or if he doesn't. That's going to have to be it. Thank you for watching and maybe see you in another life.